So, you want to own a hospital. Full beds, endless demand, healthcare that never goes out of style. On paper, it is the ultimate defensive asset. People get sick in recessions, pandemics, and bull markets. In practice, a full hospital can still go bankrupt, and the bill that kills it is often not the patients. It is the building, the insurers, and a lease structured like quicksand. This is not passive ownership. It is an active drain dressed up as a civic asset. What follows is the financial architecture underneath hospital ownership, the parts you never see on the building's facade. The fantasy starts with a true observation twisted into a false conclusion. Illness is non-optional. Trauma does not wait for an economic cycle. So ownership feels like buying a toll road across human biology. The reframe is brutal. Demand for care is not the same as demand for your care, paid at your price. A hospital does not sell a product the customer chooses freely. It sells into a maze of Medicare, Medicaid, commercial insurance contracts, self-pay patients, and charity obligations, each with a different willingness and ability to pay. You can run near capacity and still lose money on the next admission. Full census is not a profit guarantee. It is only proof that your fixed costs are being tested at scale. Before a single patient generates revenue, ownership collides with the capital wall. New general hospital construction commonly lands in the range of roughly $400 to $600 per square foot in the United States, with full projects often running from the high tens of millions into the multi-hundred-million-dollar band, depending on size, specialty, seismic rules, and market. Retrofitting legacy buildings is not cheaper in strategic terms. It is deferred modernity. Imaging suites, sterile processing, power redundancy, infection control, electronic records, and life safety systems are not optional cosmetics. They are licensed to operate infrastructure. Labor alone will dominate your operating statement for the rest of the asset's life. Nurses, specialists, techs, and the night shifts you cannot staff with enthusiasm. This is not a cafe where a renovation and a better menu can flip the unit economics in a quarter. This is a regulated industrial plant that also happens to keep people alive. Here is the silent wealth killer. Call it payer mix. Commercial insurance reimbursements typically contribute the densest per unit economics. Medicare and Medicaid are essential volume and structurally price-constrained relative to commercial rates. Self-pay and underinsured care arrives with collection rates that would bankrupt a normal retailer. So, two hospitals with identical square footage and similar occupancy can live in completely different financial realities based on who walks through the door. Urban academic centers chase complex cases and commercial density. Safety net hospitals absorb the mission volume society needs and then fight margins measured in low single digits when they are lucky. Industry analysis of U.S. hospital operating margins in recent years has clustered around the low single digits at the median, with floating estimates near 1 to 2% in tough windows, and large shares of facilities posting negative operating margins even as demand stayed high. A 3% margin on a mission-critical asset is not a lifestyle business. It is a knife edge. One labor shock, one bad contract year, one region of Medicaid expansion politics, and the edge cuts the owner. But it gets worse when people confuse the charge master with reality. Hospitals publish staggering sticker prices, the phantom menu that generates viral horror screenshots. Those list prices are not a simple tax on the public. They are the opening bid in a multiplayer negotiation with insurers, government fee schedules, and charity policies. What actually hits the income statement is net revenue after contractual adjustments, denials, underpayments, and bad debt. Ownership trains you to stare at gross charges and feel rich. Cash flow trains you to stare at collections and feel hunted. This is not a glitch. It is the core of hospital accounting. A high sticker attached to a discounted, litigated, regulated cash machine. Now, add the obligation that bars ordinary business exits. Under federal emergency care rules, commonly discussed under the EMTALA framework, hospitals that participate in Medicare generally cannot simply turn away emergency patients based on ability to pay. The emergency department becomes both a moral commitment layer and a financial stress test. It is brand, duty, liability, and uncompensated care fused into one doorway. You cannot optimize away the unprofitable presentation at 2 in the morning, the way a hotel can refuse a walk-in without a card on file. Ownership of a full-service hospital includes owning a legal and reputational duty that draws high-cost acuity into your building, whether or not your margin model wanted it. Mission and math collide at the ambulance bay. If this is already rewriting how you see essential assets, stay with it. The trap intensifies when real estate leaves the hospital's balance sheet and returns as rent forever. The textbook for this entire machine is Steward Health Care. Steward grew out of a Massachusetts Catholic system transition into a for-profit platform backed by private equity firm Cerberus Capital Management. The expansion narrative was national scale: more hospitals, more states, more enterprise value. In 2016, Steward sold hospital real estate to Medical Properties Trust, a healthcare REIT, in a package widely reported around $1.2 billion for the property side, with a broader transaction value near $1.25 billion when equity investment was included. The champagne version of the story said capital for growth. The structural version said something colder. The operator sold the land and buildings beneath the care, then rented those same facilities back under long-term leases. That is the sale-leaseback trap. Cash appears on day one, rent appears every quarter after that, fixed, escalating, and indifferent to whether Medicaid rates moved or nurses unionized. Investigative critiques later alleged that large dividend distributions flowed upstream during the private equity chapter. Major press reporting has described hundreds of millions of dollars moving to Cerberus and additional tens of millions to management in dividend events that sat beside weak operating profitability. Whether you view those figures through activist reports, legislative heat, or courtroom clawback fights, creditors and lawmakers later spent years arguing over payouts upstream, while hospitals downstream fought unpaid vendors and quality complaints. By May 2024, Steward filed for bankruptcy protection in one of the largest U.S. hospital system failures in modern memory, with debt on the order of $1 billion and a multi-state footprint under strain. Reporting in the aftermath has linked the REIT hospital model more broadly to elevated closure and bankruptcy risk relative to peer structures. Steward as the loudest public example, not a one-off cartoon villain. Care did not become optional in those communities. The capital structure did. This is not a story about medicine failing. It is a story about an ownership stack engineered for extraction speed, colliding with an industry that finances itself on thin ice. Even without private equity choreography, hospital ownership accumulates silent liabilities. Specialty labor shortages force traveler contracts at premiums that incinerate budgets overnight. Enterprise electronic health record platforms and cybersecurity are multi-year cyber-physical obligations, not IT hobbies. Malpractice, CMS conditions of participation, state licensure, certificate of need politics in some markets, and accreditation cycles turn strategy into a regulatory chess match. Supply chains for implants, drugs, and disposable sterile kits inflate with pharma and device pricing power you do not control. Every one of these lines looks manageable in a board deck. Together, they form capital consumption, the continuous reinvestment required merely to remain allowed to operate. Ownership is not collecting a dividend from permanence. Ownership is funding permanence that never finishes installing itself. If you want more elite insights like this, like the video, share it with others, and subscribe for powerful, high-level content consistently.